The Islamic banking sector in Bangladesh continues to face liquidity challenges, Fitch Rating says in its latest report. The report by the U.S. credit rating agency, however, says that liquidity is improving, underpinned by central bank support in the form of the Islamic Bank Liquidity Facility and Mudarabah liquidity support, and still notable public demand for Islamic deposit products. Islamic banks held 25.3% of all domestic industry deposits at the end of the first half of 2023, albeit down from 28.2% at the end of the first half of 2022. Islamic banks faced sizable customer deposit outflows in 2022 and in the first half of 2023 and lower liquidity buffers than conventional banks amid reports of loan irregularities. Islamic banks' excess liquidity, defined as total cash reserves minus required reserves with the central bank, declined significantly by 66.6% year-on-year, 9.82 billion takas, at the end of H1 of 2023. However, excess liquidity has since improved with a 12.7% quarterly rise. In contrast, deposit growth is slowing. Islamic banks' total deposits grew by only 3.8% year-on-year as of H1 of 2023, a significant fall from the 12% year-on-year growth of H1 of 2022. Islamic banks' vulnerability to short-term liquidity challenges is demonstrated by the fall in the liquidity coverage ratio, LCR, to 87.7% at end 2022, end -2021 to 188.5%, below the regulatory requirement of 100%. Conventional banks had adequate liquidity profiles, with an industry average LCR of 154%. The Fitch analysis said. Bangladesh had the 8th largest Islamic banking market globally at end 2022, with total assets of 4,970.7 billion takas, $45.3 billion United States dollars, ahead of Indonesia, Bahrain, Pakistan, Egypt, Jordan and Oman, based on data from the Islamic Financial Services Board. The market share, based on industry loans, is rising and reached 29.1% at end -1H23, END 1H22 28.5%. However, the industry has significant untapped potential, as 62% of the Bangladeshi population does not have an account at a financial institution, whether conventional or Islamic, according to 2021 World Bank data. Bangladesh has the third largest Muslim population globally, with sizable segments being Sharia-sensitive. Many conventional banks are increasing their offering of Islamic products, either through opening new Islamic branches or windows or by converting into full-fledged Islamic banks. This is driven by customer demand and more lax prudential requirements. Islamic branches and windows of conventional banks are expanding, with an 8.2% share of Islamic banking deposits as of end -1H23. 1H22 to 7.1%, with the remaining 91.8% held by full-fledged Islamic banks. Islamic banks in Bangladesh can receive customer deposits based on either Mudarabah, a profit and loss sharing contract, or Wadia, a safekeeping contract. Mudarabah-based deposits accounted for more than 85% of customer deposits at Islamic banks at end 1H23. Fitch hasn't observed Islamic banks passing on losses or not paying profits to depositors. Passing losses can increase reputational risk and may lead to customer deposits outflows. Fitch also expects that the central bank, Bangladesh Bank, would not let depositors bear losses as this would shake investor confidence in the banking system. Financing based on profit and loss, Mudarabah and Musharaka, was less than 1% of total financing. Green financing accounted for 3.7%, 157.18 billion takas, or $1 United States dollar. 4 billion, of all financing provided by Islamic banks at end 1H23. The Islamic finance industry in Bangladesh continues to face key structural impediments. These include a lack of sukuk and other Sharia-compliant investment options, gaps in human capital development, a lack of unified Sharia rulings, and an Islamic finance regulatory framework that requires an update. In general, the banking sector's balance sheets, governance and regulatory quality are weak. The central bank has taken steps to improve governance at public sector banks, including the appointment of observers to bank boards, but progress has been slow. The Sukuk market is nascent, with outstanding volumes of 180 billion Bangladeshi takas, 1.6 billion takas, as of end-1H23. The takaful sector accounted for 14% of Bangladesh's insurance market as of end 2022, ahead of Jordan, 13%, Egypt, 13%, the UAE, 8%, and Tunisia, 5%. The Financial Express